Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. This is for entertainment purposes only, so if you're entertained, please like and subscribe. I really appreciate that. So, I would like to talk to you today about, do we think that YieldMax is going to do okay in a bear market? Because we are facing one down now, and basically we shouldn't be investing things in a bull run if we don't think they're also going to do okay or at least survive in a bear market. So I think it's going to really suck. But I think YieldMax will still be around. I think that most of the funds will survive. But it will be good for us to have an extended period of time of a downtrend to understand in real world terms how they perform. I'm also like, I would rather, in the good times and the bad times, have done my research, have my conviction, and when there's a trash market, I just continue buying what I'm into and not try to figure out what is the next thing that's going to make me money in this exact moment. My theory is that given enough time, if I zoom out enough time, I will come out ahead. So, I actually reread the prospectus, at least some parts of it. And I know it's not the most sexy thing in the world to look at, but it really does help with understanding how these funds work. They detail it out. Basically, if YieldMax moves with the underlying, down markets are not that big of a deal because if they don't cap their upside too much, then they should recover pretty well when the underlying also recovers from the bear market. And because we're receiving income along the way, then it kind of flattens out the volatility and makes your total return greater. But one thing to note is that they're synthetic long. This is what they do to have the right to command 100 shares. Well, they can do it from 1 month to 6 months out. So I think in a bear market, it would be smart of YieldMax to go with longer dated synthetics, because if the price of the underlying isn't going up, then you're not making money on the synthetics, so you may as well delay that. You may as well delay the having to pay to close the synthetic, put it off for as long as possible. And my impression was that the bear market would suck the most for these ETFs when it initially goes down. Like when it initially goes and plummets 10 to 25% or whatever it is. Because a lot of these ETFs, especially MicroStrategy and Bitcoin in general, like it can trade, it will go down, but it will trade pretty much sideways for a while and then go back up, or it'll trade sideways a little bit and then it'll go back up, or whatever it is. If it stays within like the Bollinger Band, then even in a bear market and it hasn't recovered from the previous price, the fund managers can still work within the current bands if it's trading sideways in a bear market. So when it stops totally plummeting, that's when it'll get better. But until then, it's going to really suck. So if we don't know how long or how severe that is going to be, then having a synthetic that has less of a price and is longer dated, even though it's more expensive to get into that synthetic. At like, a part of winning in the stock market is just not losing. But Jay and his team have more experience than I do, and especially with this kind of a strategy. So when I give them my money, I am trusting them to, at least if they can't win their synthetic, the weeklies the bets that they're making for the actual cover calls, that'll be enough to cover the losses for the synthetic. So we're not guaranteed a price stabilization. We're not guaranteed that we won't be capped on the upside, and we definitely are taking on all the downside risk. So that's what happens when you trust things like YieldMax with your money to manage cover calls. And so maybe, and I don't have a problem with funds that use synthetics. It's cheaper for them to enter into the contracts, which means that the volume of contracts that they can have is much more, which in the bull market, that means that we all get bigger paydays. I'm not entirely sure how it will work in a bear market, but I'm hoping that beyond the initial it sucks, that when it is trading sideways, that the strategy will still work, and that they will actually deploy the call spreads if it's particularly volatile, and that way we can not get capped on the upside as quickly. Because for me, the most important thing is, did we move with the underlying, and how early were we capped? So that's just my opinion. And also, I've started to roll my own options because I'm not using synthetics. And so I'm using a dividend wheel, and I have more control over, I already bought this 100 shares. Do I even want to sell a call on it right now? Or I've sold these puts. Do I want to put more puts out? Or with the strike price, and I just have more control over it. And also, in this kind of a market, my inclination is to not sell out of these high income ETFs, but the distributions I receive from these income ETFs, my inclination is to actually buy the underlying or the leveraged version of the underlying. And that's because when it meets resistance and it bounces back up, then you're not capped on the upside recovery. So, but I've always advocated for just, you get your distribution and you take portions of it and you invest in other things that align with your goals. And so if you want to keep increasing your high income shares because they're cheap, then that's good. But also, if you want to take a portion and put it into the underlying, that way, if there's, a big rapid upswing, you can then take profits. You have the option to take profits. So, anyways, I think that it'll be a wild ride with YieldMax in a bear market, but hopefully we're all going to make it. What do you think? I'll talk to you later. Bye.